Frank, I was looking through our channel comments last night, and there was this one from a viewer. I think his name was David from Toronto. And honestly, it made me feel so bad because, well, he's basically bleeding cash and didn't even realize it.
Oh, really? Let me guess. Did he buy those popular US-listed tech ETFs inside his regular investment account?
Exactly. He's been working his butt off, saving money from his paycheck, converting his Canadian dollars into USD, paying those bank exchange fees, and then he realized, wait, how much did you say those currency fees actually cost?
Oh, look, it is a massive trap. Most Canadian banks will charge you anywhere from, I don't know, 1.5% to even 2.5% on the exchange rate. And here is the kicker. They charge you on the way in, and they charge you again on the way out when you sell. So you're literally losing, what, 3, maybe 4% of your entire investment just for the luxury of holding US dollars?
4%? Frank, stop. That is literally wiping out a whole year of dividend returns before he even starts.
Exactly. And it's not just the exchange fees. If you hold those US-domiciled ETFs in a non-registered account, the US IRS, the tax man down south, they just automatically claw back 15% of your dividends as a withholding tax. It's like a tiny invisible leak in your family savings bucket.
No, that's not a tiny leak, Frank. It's like a whole pipe burst in the basement. But wait, David was asking, isn't there a way to get those exact same high-growth companies, like, Microsoft, Apple, or the global markets, but without the currency headache?
Well, actually, yes. And that is exactly the secret. There are massive powerhouse growth ETFs that are listed right here on the Toronto Stock Exchange, the TSX. They're priced in Canadian dollars, which means, well, you buy them, you sell them, and you don't pay a single penny in foreign exchange fees.
Okay, this is exactly what we need to break down today, because if we can save our viewers even, I don't know, $1,000 in unnecessary fees and taxes, that's a massive win for their family budget.
Absolutely. It's all about keeping your money in your pocket, not the bank's.
All right, before we dive into the top 5, if you're new to the channel, I'm Lynn.
And I'm Frank. Welcome to Talk and Wonder. We create easy-to-understand whiteboard animations covering family finance, investing, passive income, and debt management. Our goal is to break down complex financial topics, help you avoid those sneaky traps, and, well, build real wealth together. If you want to secure your future, you are exactly in the right place.
Yes, so make sure you hit that subscribe button, grab a coffee, and let's get into the math.
All right, let's start the countdown at number 5, and we are looking at a fund called VCN. It's issued by Vanguard.
VCN. Okay, I've definitely seen that ticker on Wealthsimple. But wait, Frank, is this like 100% Canadian stocks? Because we live here, and I don't know, sometimes it feels like Canadian businesses are just banks and telecom companies. Is there actually real growth here?
You're actually on to something. But VCN is unique because it tracks the performance of wait, let me get the index name exactly right. Yes, the FTSE Canada All Cap Domestic Index. Now that word, all cap, is super important.
Right, because all cap means what? It's not just the massive players?
Exactly. It's a mix of large, mid, and small cap Canadian companies. It has about, I think, 164 companies in its portfolio right now. So instead of trying to guess whether a single stock is going to go up or crash to zero, you were buying a tiny piece of 164 businesses all at once.
I mean, that makes total sense for a family portfolio. If one company has a terrible year, say like some tech stock crashes, we still have the other 163 holding up the weight. But wait, what are the actual heavyweights inside VCN?
Well, if you look at Vanguard's site, their top 10 holdings are actually pretty familiar. Royal Bank of Canada, RBC, is at the top with a weighting of around, I think, 7%. And then Shopify is right behind it at about 5.78%.
Okay, Shopify's interesting because remember a couple of years ago when Shopify stock fell by like,
what was it, 70%? It was wild. If we had owned individual Shopify shares back then, I would have been stressed out of my mind.
God, yeah, I remember. We wouldn't have slept for weeks. But because it's inside an ETF like VCN, Shopify dropping didn't destroy the fund because the banks and energy sectors were holding steady. That's diversification in a nutshell.
Okay, so let's talk real numbers. What has the growth actually looked like? I don't want to put our money into something that just sits there like a rock.
Right. Of course, we have to say past performance doesn't dictate the future, but over the last 5 years, VCN grew on average by 11.71% per year. And since its inception back in, I believe it was 2013, it has averaged about 9.46% annually.
Wait, 11.71%? Frank, are you serious right now? That is actually really high for a boring Canadian fund.
It is. But wait, let me pause for a second because I need beginners to understand this. That 11.71% is an average. It does not mean you get exactly 11% every single year.
Right, because the market goes up and down.
Exactly. One year, the price might jump up by 30%, then the next year, some global crisis hits and goes down 20%, and then the year after, it goes up 2%. But over a 5-year stretch, it averages out to that 11.71%. For a family investor, you have to ignore the yearly roller coaster and look at the long-term trend line.
Okay, I get it. It's about patience. But what about the fees? What is the MER, the management fee?
VCN's MER is 0.05%, 0.05%.
Okay, my brain is a little slow today with percentages. Can you translate that into actual groceries and gas dollars? What does 0.05% actually mean?
Fair enough. It means if you have $10,000 invested in VCN, Vanguard takes exactly $5 a year. $5.
$5? That is literally less than the price of a pumpkin spice latte.
Yes, and that's why passive ETFs are so powerful. If you bought an actively managed mutual fund at a traditional Canadian bank, they would easily charge you 2% or more. That is $200 a year for every $10,000. Think about that difference over 20 or 30 years.
Wow, $5 versus $200? That's insane. And we get a dividend too, right?
Yes, the yield is around 2.61% right now. Since it's a growth ETF, getting a steady 2.61% dividend on top of that capital growth is, well, it's a very nice cherry on top for Canadian investors.
Okay, so VCN is our solid local baseline. It's like planting potatoes in your own backyard. It's safe, you can see it, but, well, a storm hits Canada and suddenly we're in trouble. If we want our family money to actually, capture the growth of the whole world, we can't just stay in our own backyard.
Exactly. You don't want to rely on just one country's economy, even if it is our home. And that brings us to what I call the lazy investor's ultimate dream, which is number 4 on our list. XQT. It's issued by BlackRock under their iShares brand.
XQT. I hear people talking about this one all the time on Reddit. Like, literally, every personal finance thread in Canada has someone yelling, just buy XQT and chill. But what actually is it?
Well, XQT is... Look, it's a bit of a weird beast. It's not an ETF that holds individual stocks directly. It's actually, what's the term? It's an ETF of ETFs.
Wait, what? An ETF of ETFs? That sounds like those Russian nesting dolls.
Honestly, that is the perfect analogy. It literally holds, let me check, yes, 5 other underlying ETFs. So when you buy one share of XQT, you're actually indirectly investing in, are you ready for this? 8,646 companies across the globe.
Frank, stop. 8,600 companies? Okay, I need a second.
I know, right? It's crazy.
How is that even possible with one single click on your phone? Like, what are these 5 ETFs inside it?
Okay, so let's break down the nesting doll. The biggest portion goes into U.S. equities via an ETF called ITOT, which, side note, has a funny name, but it holds giant U.S. companies like Apple, Microsoft, Nvidia, you name it. Then, for international developed markets like Europe, Japan, Australia, it holds an ETF called XEF. That gives you exposure to companies like SAP, Tesla, well, actually, Tesla is U.S., but XEF has Novartis, HSBC, Shell, companies like that.
Okay, so we've got the US, Europe, Japan. What about emerging markets like, China or India?
Yep, they've got that covered too. XQT holds XEC, which is their emerging markets ETF. So you get a slice of Samsung, Alibaba, TSMC, it's all in there. And of course, they include a chunk of Canadian stocks too, so you don't lose that home court advantage.
This sounds, it sounds incredibly robust. If one region is having a bad decade, another one might be booming. But Frank, what is the cost for this? Surely managing 8,000 companies across 5 different funds, that has to be expensive, right?
You would think so, but BlackRock kept the MER at just 0.20%, 0.20%.
Okay, let me do the math. On $10,000, that is, what, $20 a year?
Yes, exactly $20. For $20, you have a globally diversified, self-rebalancing portfolio. You don't have to do anything.
Wait, did you say self-rebalancing?
Yeah, because as the U.S. market grows or the Canadian market shrinks, the managers at BlackRock automatically adjust the weightings inside XQT to keep it at that perfect global ratio. If you tried to do that yourself with separate funds, you'd be paying trading fees, doing spreadsheets, pulling your hair out.
Yeah, and probably messing up the math. What about the historical returns?
So XQT was launched relatively recently in 2019, but in the last 5 years, it has averaged, let me check the sheet, yes, 12.38% per year. And since its inception, it's at 13.1% annually.
Wow, 13% for global diversification? That is seriously impressive.
Right? And the trailing yield, the dividends paid over the last 12 months, was around 1.96%. But their distribution yield, which is the estimated future yield based on recent payments, is actually closer to, I think, 3.16%, which is quite decent for a growth-focused portfolio.
Okay, XQT is definitely a heavyweight. But what if a family is looking at this and thinking, look, global is nice, but I really, really want to ride the wave of the biggest economy in the world, like pure, unfiltered U.S. growth?
Well, if you want to bet heavily on Uncle Sam, then you don't want to dilute your investments with Europe or Japan. You want to go straight to the source. And that brings us to number 3, which is XUU, also issued by BlackRock.
XUU. Okay, how is this different from, say, just buying a regular S&P 500 fund?
That's a really great question, Lynn, because most people, when they think of U.S. stocks, they only think of the S&P 500, the 500 biggest companies. But XUU replicates the, wait, what's the exact name? Yes, the S&P Total Market Index.
Total market. So it holds everything?
Exactly. It doesn't just hold the giants like Apple and Amazon. It holds, 2,528 companies in the U.S. That includes large cap, mid cap, and even small cap companies. So if there's a tiny tech startup in Silicon Valley that suddenly explodes into the next Nvidia, XUU already owns it. You don't miss out on the early growth phase.
Okay, but wait, is it diversified? You said it only holds U.S. companies. Isn't that kind of risky if the U.S. has a bad run?
Geographically, yes, you are 100% tied to the U.S., but sector-wise, it is incredibly diversified. You are buying a slice of, well, let's look at the breakdown. You have technology, financials, healthcare, industrials, communications, energy, real estate, and utilities. It covers literally every corner of the U.S. economy.
Okay, that makes me feel a bit better. But what about the returns? Because the U.S. has been on an absolute tear lately.
It has been wild. Over the past 5 years, XUU grew on average by 16.45% per year. 16.45%. And since its inception, back in 2015, the average is 14.17%.
Okay, Frank, stop. 16.45%? If we had put, I don't know, $10,000 in XUU 5 years ago, what would that look like today?
Well, if you invested, actually, let's use the inception numbers. If you had put just $1,000 in XUU when it launched in 2015, today that $1,000 would be worth about $3,763.
From 1,000 to over 3,700 just by letting it sit there?
Just by sitting there and doing absolutely nothing. No trading, no watching the news, nothing.
Okay, that is the power of compounding. But wait, what's the MER for XUU? It has to be low, right?
It's dirt cheap. The MER is 0.07%. 0.07%. That is $7 a year for every $10,000 you hold, or $70 for a $100,000 portfolio.
$70 for 100,000? That is basically free. But wait, what about the dividends?
The yield is lower here, which is typical for U.S. growth. The trailing yield is about 1%, and the distribution yield is 1.34%. But remember, with XUU, you aren't buying it for the quarterly payout. You are buying it because you want that 16% capital growth engine.
Right. We are looking for growth ETFs. The dividends are just like extra gas money. But wait, this is still priced in Canadian dollars, right? We don't have to convert anything.
Exactly. You buy XUU on the Toronto Stock Exchange using your Canadian dollars. No conversion fees, no foreign exchange markup. You get the full power of the entire U.S. market completely friction-free.
But, okay, if 16% growth from XXU still feels a bit too slow for your timeline, well, there is a way to put your foot on the gas pedal. It means taking on more risk, obviously, but that brings us to number 2, ZNQ. It's issued by BMO.
ZNQ, wait, is this the NASDAQ one? Because every time I open a news app, they are talking about the NASDAQ going crazy.
Yes, exactly. ZNQ tracks the performance of the NASDAQ 100. And the NASDAQ 100 is basically it's the 100 largest non-financial companies listed on the NASDAQ stock market. So yes, it has your favorite tech giants, Apple, Amazon, Microsoft, but it also has biotech and healthcare giants like Vertex Pharmaceuticals or Gilead Sciences.
Okay, so it's heavily tech-focused, but with some biotech mixed in. But Frank, let's talk about the risk, because tech can be, well, it's a roller coaster. If the tech sector takes a hit, this fund is going to hurt.
Oh, absolutely. I would classify it as medium to high risk. It is much more volatile than VCN or XEQT. But look at the numbers. Over the past 5 years, ZNQ grew on average by 22.2% per year. And since its inception in 2019, it's averaged 22.31%.
22.2%? Wait, are you serious right now? That is basically doubling your money every 3.5 years.
Exactly. The math is insane. But here is where we need to be careful, because when people see 22% returns, they want to put like their entire life savings into it, and that is a massive mistake.
Right, because if you only hold ZNQ, you're basically betting your whole family's future on one single industry. If tech has a lost decade like it did in the early 2000s after the dot-com bubble, you're stuck.
Exactly. You have to diversify beyond just one sector. You need to think about what other asset classes do you want? Do you need some bonds for stability, or even some crypto? And what about geographical exposure? You can't just rely on U.S. tech.
And also, we have to look at the fees. I was checking the MER for ZNQ earlier, and Frank, stop. 0.39%? That is almost 6 times more expensive than XXU. Why is it so high?
Yeah, it is definitely on the higher side. 0.39% means if you hold $100,000 in ZNQ, BMO takes $390 a year.
But here's how I look at it. If a fund is giving you an average of 22% growth, that $390 fee becomes, well, kind of negligible. It's a trade-off. You're paying a bit more for that massive growth engine.
Okay, I guess that's fair. But is there an alternative? Like if someone doesn't want to go with BMO?
There is actually a very similar one issued by TD called TEC. It tracks the Selective Global Technology Leaders Index. It had a 5-year average of about 22% as well, and the MER is exactly the same at 0.39%. So they're basically twins.
BMO and TD having the exact same fee. What a surprise. But look, if ZNQ is the high-speed Ferrari and VCN is the steady minivan, what is the ultimate gold standard middle ground, the one ETF that most Canadian investors choose as their number one?
That crown, without a doubt, belongs to number 1 VFV. It is issued by Vanguard, and it tracks the legendary S&P 500 index.
S&P 500, the 500 largest companies in the U.S. I mean, legendary investor Warren Buffett literally said, most people should just put their money in an S&P 500 index fund and call it a day.
Exactly, because by buying VFV, you are automatically getting a slice of Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, all the giants, and it is a passively managed fund, which is, look, this is extremely important.
Right, because passively managed means there's no highly paid Wall Street managers sitting in an office trying to guess which stocks will do well and charging us massive fees for it.
Yes, because study after study shows that those active managers almost always underperform the basic index over the long term. With VFV, the fund simply tracks the index automatically, and the S&P 500 isn't static. If a giant company starts to decline and shrinks below the market cap requirement, it gets kicked out, and a new fast-growing company takes its place. The index cleans itself.
That is actually so elegant. It's like a self-cleaning oven for your portfolio. So what are the numbers for VFV?
Over the past 5 years, VFV's average annual performance was 16.95%, and since its inception in 2012, it has averaged 17.88% per year.
17% over more than a decade? That is just incredible. And the fee?
Ultra low. The MER is only 0.09%, 0.09%. That's $9 a year for every $10,000 invested. The trailing yield is about 0.95%, and the distribution yield is 1%.
Okay, so VFV is basically the absolute powerhouse. But Frank, we need to address the elephant in the room. If we buy VFV or ZNQ or XEQT and they grow by 12% or 17%, what happens when we sell? Because the tax man is going to want his share of those capital gains, and our dividends are taxable too.
Yeah, if you hold these in a regular, non-registered taxable account, every time you get a dividend or every time you sell for a profit, you're going to get hit with a tax bill. It can eat up literally thousands of dollars of your growth over time.
Exactly. But as Canadians, we have this, well, it's basically a financial superpower that many beginners completely underutilize. I'm talking about our registered accounts, the TFSA and the RRSP.
Yes, the TFSA, Tax-Free Savings Account, is, honestly, the name is misleading because it shouldn't be called a savings account. It's an investing account. When you buy these growth ETFs inside your TFSA, any capital gains, any interest, and any dividends you receive, they grow completely 100% tax-free. When you withdraw the money, you pay zero tax.
Zero, not a single penny to the CRA. And then there's the RRSP, the Registered Retirement Savings Plan, which lets you deduct your contributions from your taxable income today, and the money grows tax-free until you retire.
Right. So if you're a Canadian family, before you open a regular trading account, you must maximize your TFSA and RRSP first. It's the ultimate legal tax shield.
But wait, Frank, if we have limited cash to invest this month, how do we actually decide how much goes into the TFSA versus the RRSP? Because the contribution limits are different. And if we put the wrong ETF in the wrong account, don't we still get hit with some U.S. withholding taxes on those dividends?
Well, that is actually, look, that is a highly debated topic. The math on TFSA versus RRSP is, well, it depends heavily on your current income bracket compared to what you expect to make in retirement. And as for the withholding tax, it actually behaves differently depending on which account you use, which is,
Wait, are you telling me we might still be paying taxes inside our tax-free accounts because of the U.S. rules?
well, yes, but it's complicated, and we really need to look at